Essentially, what the RBI has put out in the macroeconomic developments report for the third quarter is that anything that needs to come from monetary policy action will have to be, can only be followed by action on the fiscal front. So what it has said is that front-loaded fiscal consolidation would generate sufficient space for monetary policy to act without stoking inflationary pressure. So it's essentially saying that if you want the RBI to act by way of monetary policy action, the RBI will have to first see the government move on the fiscal front. Now, it has acknowledged the fact that the government has been doing a lot since September 2012. It has also talked about the fact that in this month alone, numerous efforts have been taken by the Finance Ministry by way of curtailing expenditure, by way of addressing some of the subsidy challenges, the diesel price increase, the staggered price increase having, of course, being one of them. But it has said that in an environment where you have high inflation, a high current account, and a high fiscal deficit, any monetary policy action to support growth is not going to be effective unless it is supported or led by fiscal consolidation on the part of the government. So essentially saying that, monetary policy action so far taken has done what it could. It's not going to be effective, very effective going forward unless it is backed up or led by action on the fiscal front. Essentially telling, or rather conveying the message to the centre that you'll have to continue with fiscal reforms, that the RBI will need to see the government take a lot more initiative, a lot more steps on the fiscal front if monetary policy action must carry through. Now, does this mean that you may not see a rate cut tomorrow? That's quite unlikely, to the extent that the RBI has already guided for a rate cut, maybe not tomorrow, but at least in the fourth quarter. So that rate cut is coming. The market somewhere has priced in a 0.25 percentage point cut for tomorrow, maybe even in March. So that 0.25 percentage point cut is coming. But going forward, the RBI has said that inflation challenges will continue to hold up. It has, of course, said that core inflation has come off and is unlikely to rear its head, to worrying levels anytime in the near future. But inflation continues to remain a challenge. Fiscal consolidation, fiscal reforms, economic reforms will need to be seen if monetary policy action needs to be followed up with. Essentially meaning that if you are going to see a rate cut tomorrow, future rate cuts are purely and 100% dependent on action on the part of the centre. So what the RBI has done is that it has squarely thrown the ball in the court of the Finance Ministry and said, you guys lead the initiative, we'll follow. We'd like to see fiscal action on the fiscal front, and you can be rest assured that you will see monetary policy action followed up with. So anything from here on by way of monetary policy action, the RBI has indicated, will have to be, or rather will be, determined by action from the centre.
That's right, George, that the RBI governor has been saying for quite some time, but in the middle, the kind of comments that came out from the governor was a little bit tilting towards the growth aspect, and then he came back on the concerns raised from inflation. This time around, which way is the governor really tilting at this point?
Look, Nisha, what he's said is that growth challenges remain. And again, if you go by the professional forecasters survey, they've actually revised their growth outlook for 2012-13 to 5.5% from an earlier number of 5.7%. And remember, the RBI in October had guided for GDP growth at 5.8%. By all means, in all likelihood, you will see the RBI revise that growth number tomorrow. They've also said today in today's report that the 5.8% number that they put out in October is nowhere near going to be achieved. So you can expect that number is going to be revised. Possibly they may toe the professional forecasters line and say 5.5%, maybe even 5.6%. But on the growth front, they do acknowledge that there are numerous challenges. But going back, they've actually drawn a fine balance between this whole thing of growth having to be or this expectation that growth is going to be almost entirely supported by monetary policy action, and they're trying to play down that expectations which somewhere seems to have got built into the minds of most people. What it is saying is that monetary policy action by itself is useless. It's not going to have the desired effect on growth unless you see action on the fiscal front. So they are saying that the macroeconomic challenges somewhere are very balanced. So you've got the challenge of inflation on the one hand, you've got the challenge of growth on the other hand. What it is saying is that all these challenges can only be addressed by fiscal action. What it is saying is that the government needs to address the challenge of high inflation. It needs to address the supply side aspects that are posing a threat to bringing inflation down. It needs to address the issue of a high fiscal deficit by way of improving revenues or curtailing expenditure or both or however else. Also, the fact that the current account deficit is at an at an extremely high level. It's likely to end this year at 4% plus, like it did in the previous financial year. That itself, when you have a high current account deficit position, monetary policy action is useless, is not effective enough simply because it feeds into inflation. It tends to be inflationary in nature. So, what it is saying is that anything from here on will have to be led by the government. That monetary policy action by itself is not going to fix the challenges that the three challenges: inflation, current account, and fiscal deficit. These are challenges. The answers to which lie in the hands, the solutions to which lie in the hands of the government. The government will have to move, and once the government moves, monetary policy action can follow up the actions of the government, and then interest rate cuts will be effective. So that's the essential message coming out from the Reserve Bank of India.
But George, while RBI governor's message has been loud and clear to the centre and to the government as well, the government has been patting its back on the reform measures that it has taken over the past few months as well. Some bit of diesel deregulation, partial bit of it, even trying to cut down on the gold imports to really curtail the widening current account deficit. Some of these measures have been taken. What are economists saying? What is the view at the RBI? Are these measures really enough?
No, I think, the RBI is not saying that these measures are enough. The RBI has acknowledged the fact that the government is moving on, addressing many of these challenges, and some of those you just listed out. So it has said that beginning September of last year, the government has got moving, and it has talked about the fact that the government in January alone has addressed numerous issues. So whether it be, the point you mentioned, the fact that gold imports, the tax has been raised by 50%, whether it be, diesel prices being raised in a staggered manner over the course of the next few months to bring it in line with market rates. All of this action is commendable. What the RBI is saying is that it is not enough. We haven't fixed even half our problems. You need to continue with the reforms exercise if you need to see monetary policy action being followed up by that and monetary policy action being effective. So, is the RBI disappointed with the government in what it has done so far? Absolutely not. It has actually commended the government for what it has done so far. What it is saying is that this momentum so far needs to be carried through. It needs to continue. You need to see reforms on a whole lot of other issues as well. And you need to fix, those points that I mentioned, the supply side element of inflation. You need to get the fiscal in order. You need to bring current account deficit to more manageable levels. 2.5% is the more manageable level. Once you see that carry through, only then can you expect a monetary policy action to be effective. That's the clear message coming from the RBI.